Federal Reserve looking to start raising interest rates next week. The trickle-down effect for consumers could be more inflated prices. And personal finance expert Gene Marks joins us now with some tax-saving tips about what to do concerning inflation. I just want to thank you for coming on and joining us. I always feel like the term trickle-down effect is kind of like this thing that really doesn't exist. But tell us how this could actually apply with this year.
Yeah, sure. I mean, Rob, it's good to be on. I mean, listen, I think it's no news right now that we're seeing, high inflation. And, I'm preparing you and your viewers as well that inflation is going to continue into 2022. And there are a lot of factors that are playing into that. So the question is this, Rob, right? I mean, if you know that prices are going to be going up, what do you do individually to protect yourself? I mean, not just yourself, but even if you're a small business owner, how do you protect yourself? So I've got some thoughts for you to consider as you go into 2022, okay? If you know that interest rates are going to be going up, one of the good places to hedge against inflation are interest-bearing accounts. They've been kind of ignored over the years when interest has been so low. But now if you've got money sitting in your checking account or very, very low savings account, you want to move those into savings accounts where they are interest-bearing because your banks are going to start paying more interest. So it makes sense that you can earn more money on that. So take advantage of that, right? You were talking earlier about, home prices, real estate and property is also a very good area to go in inflationary times. Real estate property tend to go up along with inflation. And if you do have the capital to buy and rent property out, that also keeps up with inflation. And that's always a good thing to consider. If you've got retirement plans, the stock market over time generally outpaces all other types of investments that you make. And so by putting as much money as you can safely into equities and stocks in your retirement funds, you should generally keep up with inflation as well, because big corporations, they're making moves to cut their costs and keep their profits going up. And that should also impact their stock prices. And finally, if you really want to get a little risky, certain commodities do well in an inflationary period, like gold and copper. Please don't bet the house on that stuff. But if you want to take a little bit and put it in there and be a little bit aggressive, that's some things that some of our clients are doing. You certainly want to talk to your financial advisor and your tax advisor about all these things. But there are moves that you can take to protect yourself against inflation.
Well, there's a saying that always goes like this: buy low, sell high.
Sell high.
But if you do have money, you were talking about, and we were just talking about credit cards. Now, if you do have some extra money on hand, is it smarter this time of year to go ahead and pay off credit card bills or to invest it?
Well, first of all, it's always smarter to pay down your credit card bills because most credit cards charge excessive amounts of interest, anywhere from 15 to 25, 30%. And unless you're really picking some great stocks, and if you are, let me know, you're probably not going to be earning that kind of a return on your investment. So yes, you want to pay down your credit card debt, even if that means taking a home equity loan, for example, which generally has much lower rates of interest. Those can be used to pay down those higher credit card debts. Credit cards should be used, Rob, for short-term financing only. Try not to carry a balance when you can.
All right, that is Gene Marks, personal finance expert. Gene, thank you for all the healthy tips that you offering.
Thanks, Rob. Have a great New Year.
All right, you too.